Hey guys, welcome to the episode 190 of the Bitcoin Fortress podcast, building your stronghold in a world of fiat chaos, one block at a time. It's November 16th, 2025. We are at block height 923910, Moscow time 1062 sats per dollar, and fees are 3, 4, and 5 sats per VByte for low, medium, and high. Bitcoin is trading around $95,000 today after a bruising week of volatility and macro drama. Today's episode will go over the week's Bitcoin news, the big themes from the Bitcoin podcast universe, talk about our featured Substack post from the Bitcoin Fortress Substack, When AI Eats Wall Street, a quick reminder about my 3 Bitcoin Fortress books, and then we will wrap it up. So with that, let's jump into the news. So first we'll start with price action, macro, and market structure. Yahoo Finance framed this week as Bitcoin sliding into a bear market regime as the price dipped below 95,000, erasing most of its year-to-date gains. They highlight ETF outflows, macro jitters, and fading rate cut hopes as the main drivers. Of course, 20% plus drawdown from the October all-time high does put us into a technical bear market territory. Not going to lie, it's been on my mind a lot lately. But bear markets are for stacking and for building and for focusing on um, lots of other things besides the price. So, in fact, I'm going to be writing some pieces on that in the next few weeks to help, and also some videos to kind of help center us on that because we could be in a bear market, or it could just be a pullback as part of the bull market. You just never know. Again, the narrative whiplash. We're going from hyper Bitcoinization any day now. People confidently forecasting $200,000-$300,000 Bitcoin by the end of the year to Bitcoin is dead. Bitcoin is dead again in 30 days. So again, well, that's the narrative for you. So again, if you stay calm, stay focused, and stay centered, uh, you can, and maybe turn off the TV, turn off the noise. It helps certainly. But of course, volatility is the feature, not a bug in Bitcoin. So it breaks those who try to trade on the way up or on the way down, and shakes people off. And people that hold patiently through cycles are usually well rewarded relative to anything else. At least that's what Bitcoin's brief history has shown us. Reuters reported Bitcoin dropping to its lowest level in 6 months, around the mid $95,000 range, with a broad risk off move across equities as the Fed signals less urgency to cut rates after the long government shutdown. So, of course, we all know this, but Bitcoin still trades like a high beta macro asset in the short term, a risk on type of a thing. Rate cut probabilities for December have been slashed, and Bitcoin trades with that narrative. So, money printer go burr. They'll find ways to print money, of course, without doing the interest rate thing if they have to. The system needs liquidity in order for it to survive. More debt, more money printing, and we can rest assured that will happen eventually. Bitcoin's still up massively year over year, but leverage and expectations got ahead of reality. So there. AlphaSpread did a recap of Friday's move. Bitcoin fell below $95,000, calling it a deepening bear market, with nearly 900 million pulled from funds and whales selling into weakness for profit taking rather than panic. Interesting thing about the whale, when I did a little research on this, I'll be writing a piece in the next couple weeks in the Bitcoin Fortress podcast, but they are not mythical creatures. They they have profits. They can sell without destroying the market. They will, and they will put their money into, well, I don't know, something else for the time being, maybe. They still have probably a lot of Bitcoin anyway, even if they are taking profits. So anyway, it's an interesting area of inquiry. They are not mythical. They are humans, and they're doing what humans do. So at some point, they will be done selling, and then buyers take over, and then we have a market that flattens out and begins to move back up, as most assets do over the long haul. Certainly, Bitcoin has been better than many. Big players locking in gains after the run to new all-time highs in October. That's certainly what's happening with the whales. Market depth and liquidity, however, have been stressed and is getting less and less able to absorb large sells. And so, again, at some point, selling just kind of peters out. Um, and again, I think this probably has a good chance of being a classic shakeout before the next leg, again, as long as the fundamentals stay strong. Or we could be at the beginning of a bear market. I don't know. Bitcoin does what Bitcoin will do. All I know is there's one chart that just is seared in my mind, and that's the global liquidity, which is a hockey stick, and Bitcoin is curling over and downward, and the gap between global liquidity and Bitcoin is widening at a growing rate. And that just doesn't seem to me to be sustainable, meaning that Bitcoin at some point is going to have to close that gap. And so we just have to be patient. Yahoo Finance also pointed out that Bitcoin dropped about 10% after the October 29th Fed rate cut, bucking the usual easy money equals risk on pattern. So again, I think probably here the markets had already front run the cut, buy the rumor, sell the news. This does signal that Bitcoin isn't just a simple function of rates. Positioning and narratives, of course, matter. And again, as we like to talk about here on the show, long-term conviction beats trade the Fed games. Play fiat games, win fiat prizes. AInvest covered how the end of the 43-day US government shutdown sparked a partial rebound in crypto markets, with Bitcoin trading back above 100,000 intraday, but failing to hold those levels as volatility remained elevated. Policy chaos and shutdowns are now part of the background noise. And of course, again, if you look at what happened last week, the Bitcoin price was all over the place. And that is the volatility that we see, and we have to understand. Markets are trying to price Trump's stimulus talk, tariffs, and long-term deficits. I think we may have talked about this last week, but he came out with a tariff rebate, tax rebate to folks, a couple $1,000. Also talked about 50-year mortgages for homes. I think I want to say, I don't know if this was a Trump tweet, but there's also been some talk about longer term auto loans too. Uh, and again, long-term deficits. The government's not really serious about cutting its spending. So the shutdown's over, maybe, but the debt problem is not. And again, I think this is long-term bullish for hard assets, including and probably most importantly, Bitcoin. Live Bitcoin news echoed the story. Bitcoin briefly reclaimed 101,000 as Trump officially ended the shutdown, with traders eyeing potential stimulus and renewed risk appetite. And again, fast swings around political headlines are a wonderful teaching moment for us on not chasing candles because you will get burned. Uh, no pun intended. You can't build a retirement plan off of 24-hour headlines, but of course they do move short-term price. So as always, it's wise to zoom out, focus on the big picture, stay humble, stack sats. Binance's November 9th market update showed Bitcoin trading between 101,400 and 102,630, highlighting low timeframe chop, indecision, and profit taking after the all-time highs. Classic post all-time high range. Leveraged players try to front run the next move, whether that's going to be up or down. And for stackers, this just means stack in the range and ignore the noise. And finally, in this segment, Castle Crypto reported Bitcoin crashing under 97,000, triggering an estimated 800 million to 1 billion plus in long liquidations in just 24 hours as highly leveraged bets blew up. This is why 10x perpetuals are not a retirement plan. And healthy, this is healthy, of course, from a structural standpoint. It flushes out the weak hands and the leverage, and the long-term hodlers don't get liquidated. They just ride the volatility. So with your coins safely in safe storage, you can observe the headlines with curiosity and not panic. Next segment, we'll go into ETFs, institutional flows, and corporate treasuries. And let's see what we have here. Crypto Slate noted that on November 11th, spot Bitcoin ETFs saw 524 million in inflows, followed by 278 million in outflows on November 12th, an $800 million swing as traders braced for CPI data and rising long-term yields. ETFs are now a major macro sentiment gauge. Short-term flows are noisy, but the trend still shows persistent institutional interest. Nonetheless, whether they're buying or selling, they seem to be interested. And it's a great way for us to understand Wall Street plumbing and how that all works relative to Bitcoin. So again, the ETFs are big buyers and big sellers of Bitcoin, but they do tend to move with macro, which is what we probably would expect. And again, we know that Bitcoin is treated like a risk-on asset. Crypto DNES reported that US Bitcoin ETFs recorded about 2.39 billion in net inflows over the past week, one of the strongest since March, despite the price drawdown. So with price down, institutions buying, classic divergence that long-term bulls like me love to see. It also reinforces Bitcoin as super collateral. I'll be writing about that actually coming up next week in the podcast, in the Substack, and the Treasury asset narrative. So, regardless of the inflows and outflows, overall, they're still buying, accumulating, as the OGs and whoever is selling are distributing. Trading news highlighted a 524 million single day inflow, with BlackRock's IBIT leading, and total US spot ETFs now holding more than 1.54 million Bitcoin, or roughly 7.3% of the supply. So again, Wall Street owns a non-trivial chunk of outstanding supply already that they've been gobbling up since the ETFs first came on the scene. And again, ETFs can't really break Bitcoin. They can certainly influence the price. in the short term, depending on whether they're buying and selling a lot in the short term, but in the long term, they seem to be accumulating. And this is an easy way for institutions to get exposure to Bitcoin, even though uh, we prefer self-custody. And again, owning an ETF perhaps provides you with liquidity. Maybe you can borrow against it in your brokerage account. You could sell it for cash and have cash. You could also do the same thing in self-custody. You could get a loan if you needed some liquidity, but personally, I try to stay away from the Bitcoin loans until they're absolutely necessary. Don't like the stress of having to watch the price and, margin calls and all that stuff. Data from Soso Value and BitBo show how November 11th saw big net inflows, followed by November 12th to November 13th outflows as rate fears returned. So again, flows are tracking macro data releases almost tick for tick, which is quite interesting. ETFs don't really cause the bear market, but they multiply macro sentiment into Bitcoin. And so that's the thing we have to remember when we watch all this stuff. KuCoin's flash update noted 492 million in net outflows from Bitcoin ETFs on November 14th, while XRP and Solana ETFs saw fresh inflows. So the tourist capital is rotating into the shiny shitcoin alternative narratives, and this is why we just are Bitcoin only, because those there there's just not the same value in the shitcoins as there is in Bitcoin. But again, people are chasing returns, and if they think they're quote undervalued and they're going to rock it up, they're going to try to catch that, sell it, and maybe put the money back into Bitcoin later. Who knows? But we are Bitcoin only here. And finally, in this segment, PYMNTS reported that the recent price downturn is pressuring the crypto treasury space, with some firms trimming Bitcoin exposure or pausing new allocations. So, some companies still treat Bitcoin as a speculative line item and not a strategic reserve. And I would contrast this with strategy, which has conviction, and they continue to buy in any market, uh, and continue to find ways to raise more money to buy more Bitcoin. And of course, you have El Salvador, who are just happily stacking. I think it's something like a Bitcoin a day or something like that. A Bitcoin a day keeps the IMF away. Moving on, next segment, mining infrastructure and energy. CoinDesk quoted Mara Holdings CEO saying miners will increasingly need to own or tightly control their power to survive, especially heading into the 2028 halving, and that many are pivoting some capacity to AI and HPC workloads. This sort of confirms my thesis that mining is converging with broader energy and compute markets. Uh, Also, you should look at home mining with a bid axe versus industrial miners chasing AI. This is a pretty good contrast that, again, when you're home mining with a bit axe, your compute is totally dedicated to the Bitcoin network versus the industrial miners are going to be switching that on and switching that off as this AI comes into the forefront. But again, they have a business to run. They want to grow. They want to have success in the future. And if you're completely 100% married to Bitcoin, then you could, obviously in a bear market, could be in a lot of trouble. And that's what's happened in the past. A lot of the smaller miners have gotten swallowed up by the bigger ones, gone out of business because they just can't, especially after a halving, because there's just less coins with every block that you mine. The other thing I thought that was kind of interesting about this article is that the 2028 halving is already on serious miners' radar, and we can't forget that as well. And that's going to be another liquidity event for the network where the block reward will get cut in half yet again, further reducing the amount of Bitcoin that's being issued with every block, which I think technically now Bitcoin has a stock to flow ratio that's um, less than gold. For a while there, it was slightly above gold, but now it is officially less than gold with this latest halving, and it will only get more scarce with each subsequent halving. Yahoo Finance reported that listed Bitcoin miners collectively lost nearly $8 billion in market cap in one trading session during this week's sell off. Ouch. Again, something to remember, miners are a leveraged play on Bitcoin price and fees. They are not Bitcoin. But if you like to play in the stock market and you like Bitcoin and Bitcoin adjacent things, they're fun, they're interesting, but just like gold miners or silver miners, they are leveraged to the underlying commodity and will crash terribly when the price is down of the commodity, and they will blow up when the price goes up. But again, this sort of highlights the risk of owning miners versus owning actual Bitcoin in cold storage. Reuters covered American Bitcoin, backed by two of Trump's sons, swinging to third quarter profit as mining capacity and margins expanded with higher prices earlier in the year. Politically branded mining is now a thing, and this reinforces how Bitcoin has become part of the new US political economic landscape. Fortune reported that Anthony and AJ Scaramucci led a $220 million investment into a US Bitcoin mining company tied to Trump's family interests, with the quote, "Bitcoin transcends politics." The Bitcoin GOP narrative continues to strengthen, and institutional capital and political capital are converging around mining. Finally, in this segment, Crypto Ninjas ran a piece on cloud mining in 2025, calling the sector full of opportunities and hazards, and warning about opaque platforms versus more transparent providers. And so, for those of you that don't know, because they advertise them on podcasts and everything, there are companies where you can buy a miner, give them some cash, they buy a miner for you, and they operate it for you. And you get a share of whatever Bitcoin gets mined, less, of course, operating costs. And some of these folks are reputable, some of them are sketch. I myself have not participated in any of those types of things. I just bought a couple bit axes and plugged them in here at my house. And if I get lucky someday, I might find a block. And if I don't, well, at least I'm supporting the network and I'm learning about mining. So that's kind of how I see it. Uh, I think it's probably from a return on investment standpoint, much better to just run a small little transparent home miner or just simply buy Bitcoin directly rather than participate in some of these things, especially because, you've got a lot of counterparty risk between here and your Bitcoin on these cloud mining things. But it's up to you. Do your own homework on that, of course. All right, next segment, we're going to talk about adoption, payments, and Lightning. Reuters reported that SoFi is rolling out crypto trading directly in its banking app, letting customers buy, sell, and hold Bitcoin and other major coins, calling itself the first US bank to do so. So, this is, to me, more evidence that every bank will eventually be a Bitcoin bank, and custodial on ramps are growing. But just because you buy on an exchange doesn't mean you hold on an exchange. Always withdraw to self-custody so your coins are nice and safe. The Block and Yahoo covered Cash App's new upgrade, adding Lightning Network payments and stablecoin transfers, pushing Bitcoin as a day-to-day payment option to tens of millions of users. This is a massive UX step. Millions can now pay over Lightning in apps they already use. And again, the concept being Bitcoin as your savings, Lightning as spending. This story keeps getting stronger and stronger. So again, if Lightning's working well, you don't really need shitcoins. You don't need altcoins. You can just carve off a piece of your Bitcoin and put it in your Lightning wallet and then use that for your small spends. BitGet and CoinSpeaker reported that Square now supports Bitcoin payments for merchants globally, integrating Lightning with instant settlement and flexible conversion into fiat. This is merchant adoption without volatility risk, convert to fiat automatically if they want. And this is also a great case study of Bitcoin Rails plus fiat opt-out path. You can stack sats instead of dollars. So we'll see how that rollout continues, but that was some pretty exciting news. CoinLaw's recent stats piece says the Lightning Network is handling over 8 million monthly transactions, with public Lightning volume up 266% year over year, even though public channel count is down. So Lightning seems to be quietly scaling in the background. Fewer public channels, but more volume means better routing and more private channels, because we don't see those, I guess. Protos highlighted an online poll where over 80% of respondents said Lightning doesn't count as, quote, real Bitcoin. What? This is a great opportunity to explain how that Lightning Network payments are still settled in Bitcoin. It is Bitcoin. Uh, There's obviously an education gap. Many don't understand Bitcoin layers versus tokens. And so we need to really make sure we understand that. And that, again, when you open a channel, something gets recorded on the chain. And when you close a channel, it gets recorded on chain. But everything that happens in between is actually private, and it is Bitcoin going through the Lightning Network, it's still Bitcoin. And actually, again, the privacy benefits of using Lightning payments is and the liquidity of it, but I like the privacy personally the most. Keeps everything off the chain. The weekly Lightning Thursday thread on Our Bitcoin once again offered education, app reviews, and Q&A, reinforcing community-driven learning. Grassroots education still matters as much as big corporate integrations, and so that's probably something you might even want to check out yourself. Coinpedia noting that adopting Bitcoin 2025 in El Salvador, which ran on November 14th and 15th, focused heavily on Lightning and real-world Bitcoin use in the global south. El Salvador is continuing to act as the Bitcoin lab for the world, which we love to see. And conferences there are increasingly about builders and merchants, not just the price. And finally, in this segment, BitPenises, I'm not kidding, it's BITPINAS, BitPinas, weekly roundup covered key stories from Singapore, Dubai, and the Philippines, including regional moves in regulation and crypto services that impact Bitcoin adoption. Bitcoin adoption is genuinely global, lots happening around the US bubble, outside the US bubble. And it's good to remind all of you that remittances and emerging market use cases are pretty compelling outside the United States. So, as it seems like people that need Bitcoin tend to understand Bitcoin a lot quicker. And that's going to be in countries that have hyperinflation, really authoritarian governments, et cetera, et cetera. So Bitcoin is for everyone. Next up, let's take a look at regulation, enforcement, and policy. Reuters again reported that Chinese national Jimin Qian was jailed in the UK for running a giant investment fraud, with police seizing around 61,000 Bitcoin, likely the largest on chain seizure ever. Now, we all must remember law enforcement can seize coins if they get the keys, devices, and exchange access. And I did write about this recently on the Bitcoin Fortress Substack on how governments actually get access to Bitcoin. Probably worth a read if you get time. But it's also a nice reminder about OPSEC. Keep your security tight. And also don't do anything illegal. Next up, CoinGape summarized remarks from SEC Chair Paul Atkins on a new crypto rulebook, including clearer paths for compliant offerings and custody, while also mentioning Michael Saylor debunking rumors that Strategy was selling Bitcoin, Saylor teasing another potential Bitcoin purchase, ongoing SEC review of altcoin ETFs. And again, we kind of are continue to see this shift from regulation by enforcement or suing people toward clearer guardrails, which is certainly welcomed by the industry. And Sailor still broadcasting pure HODL energy in the storm. IQ write-up explained a new SEC no action letter that clarifies how state-chartered trust companies can act as qualified custodians for digital assets if they meet due diligence and oversight standards. So this is a big deal for registered investment advisors and funds wanting to hold quote unquote proper Bitcoin exposure. More competition in custody, of course, is good for the users, but self-custody is king. But there's still people that don't feel comfortable with that, or if you have a huge amount of money and not a lot of time, maybe you want to have a custodian. Uh, I'm thinking family offices, high net worth individuals, but it's certainly not as good as holding your own coin. You're holding your own keys and your coins. JD Supra's weekly blockchain blog recapped letters from major U.S. bank lobbies urging the OCC to reject 6 pending digital asset trust applications worried about competition and regulatory arbitrage. So we can see banks want crypto access, but they also want to keep the newcomers out. No surprise there. Classic incumbents versus upstarts story playing out around Bitcoin custody. Everybody wants a piece of that action. Finally, Galaxy Digital Research reviewed China's renewed crackdown on OTC crypto desks and informal trading routes, arguing that this ultimately makes Bitcoin more resilient by pushing activity to more open jurisdictions and decentralizing the network. This is a perfect illustration of you can ban yourself from Bitcoin, but not ban Bitcoin. And also, you can kind of see Bitcoin censorship resistance and global game theory playing out every time China bans Bitcoin, which they have done many, many times in the past. And it's good to see that they are, so far, have not been very successful in stopping the network. Next, we will go over sentiment, commentary, and media. So let's see what we have here. Investopedia covered Michael Saylor's response to the price drop. He dismissed rumors of selling and doubled down on his HODL message, literally posting himself on a life raft with HODL over a burning ship. Great meme energy for a rough week. And of course, this is a great opportunity for me to reiterate my own stay humble stack sats theme. Uh, it's, of course, challenging when you watch this, but you have to zoom out and focus on staying resilient during drawdowns. And finally, NASDAQ published a piece where they asked ChatGPT about Bitcoin's 2026 outlook, listing bullish drivers like adoption and ETF flows, and bearish risks like regulation, higher rates, and altcoin competition. Mainstream still frames Bitcoin mostly in price terms, not monetary revolution terms. And you can gently critique surface level AI takes versus deep on chain and macro analysis. Next up, let's take a look at the Bitcoin podcast themes from the past week. The first one being sovereignty and personal responsibility. So, what Bitcoin did released what it really means to be sovereign, with Seed Signer digging into what sovereignty actually looks like, key management, threat modeling, and living a lower time preference life. Uh, Pretty strong echo here from my Bitcoin lifestyle and self sovereignty essays. Reinforces that hardware, multisig, and OPSEC are now mainstream talking points. Another What Bitcoin Did episode focused on Bitcoin power law, the end of exponential growth, discussing how Bitcoin may be transitioning from crazy exponential cycle to more muted power law driven growth as it matures. Uh, Again, for those of you who are anxious about the recent drawdown, this is wonderful framing. The upshot here is the price may grind, but fundamentals and adoption channels are much stronger than in prior cycles. And so number will go up, but not hopefully with ridiculous huge spikes up and massive drawdowns. Hopefully that's getting a bit more muted as Bitcoin matures. Over on TFTC, Marty Bent dropped the health insurance death spiral is here, tying Bitcoin to the broader US healthcare and insurance crisis, and how fiat incentives distort everything from cost to coverage. Bitcoin keeps showing up in conversations about totally different, but still broken systems. Debt, healthcare, pensions, all roads lead back to the broken money. Stefan Livera's latest episode, Bitcoin Adoption in Mexico and Ario, talked with Gustavo Flores about building a Bitcoin company in Mexico, cultural hurdles, and local financial realities. This reinforces that the most interesting Bitcoin stories are often outside the US, and it ties in nicely with the Adopting Bitcoin conference in El Salvador. The Breakdown ran an episode, Bitcoin's 100K test and the return of stimmy checks, tying this recent dip in Trump's stimulus tariff talk into the broader macro environment. This kind of bridges some of the things that we've talked about recently on tariffs and 50-year mortgages and stimulus being bullish for Bitcoin. And again, the shows are starting to sound more like macro with Bitcoin as a base layer. Across the Milk Road podcast and other shows, we're seeing more discussion about Bitcoin's next big move and some episodes explicitly asking whether crypto was built for AI more than humans, plus segments on how AI might model Bitcoin to 180,000 versus 80,000. AI Bitcoin now a recurring theme, not a fringe idea. So, again, just to summarize across the Bitcoin podcast universe this week, I'm hearing a few clear themes. Sovereignty and self custody are front and center. Market structure is maturing. Think power laws instead of rocket ships forever. Bitcoin is increasingly framed as the antidote to structural fiat failures. And the AI plus Bitcoin narrative is popping up more often, not less. Did want to mention this week's featured Substack post next, When AI Eats Wall Street. In that essay, I explore a simple but radical idea. If AI can automate research, risk modeling, compliance, and execution at scale, And if markets are mostly about information and incentives, then the traditional Wall Street stack, massive headcount, skyscraper rent, layers of middle management, is ripe to be replaced by thin, automated Bitcoin native rails. Post walks through how AI shrinks margins in legacy finance. No more fat fees for mediocre active management. Bitcoin becomes the neutral settlement layer for AI driven agents transacting 24/7 globally. The combo of AI and Bitcoin erodes the moat of big banks and brokerages, pushing capital directly between savers, entrepreneurs, and smart contracts. I also look at what happens when Wall Street is forced to compete with open source risk engines and algorithmic treasuries. Retail investors can outsource asset allocation to AI that isn't conflicted by sales quotas. Bitcoin acts as final settlement while AI handles everything above that layer. The conclusion is pretty simple. We're moving from too big to fail Wall Street to too distributed to stop open financial systems. Bitcoin is the base money and base settlement. AI optimizes around it. If you haven't read it yet, check out When AI Eats Wall Street on the Bitcoin Fortress Substack. I'll link in the show notes, and feel free to share it with your more tech curious friends in TradFi. Before we wrap, a quick reminder about my 3 Bitcoin Fortress books that expand on a lot of the themes we talk about each week. The first one being Bitcoin Fortress, a simple guide for beginners, which is a straightforward introduction to Bitcoin, what it is, why it matters, how to buy, secure, think about it without getting lost in jargon. Next is Bitcoin Retirement and Estate Planning, a deep dive into using Bitcoin as part of a long-term plan, retirement modeling, tax strategy, IRAs, trusts, and passing Bitcoin to the next generation safely. And finally, my most recent book, The Bitcoin Lifestyle, a more spiritual, philosophical look at how aligning your life around sound money can reduce anxiety, lower time preference, and free you to focus on faith, family, meaningful work, and service. If you enjoy the podcast, these books are designed to be printable, shareable version of Bitcoin Fortress, something you can hand to friends, family, or coworkers when they're ready to go deeper, and just in time for Christmas. That's it for episode 190 of the Bitcoin Fortress podcast. This week we saw Bitcoin get punched in the face by macro, yet ETFs still quietly stack sats, miners feeling the squeeze even as big politically connected money pours into the space. Lightning and real world adoption stepping forward in Cash App, Square, SoFi, and conferences like Adopting Bitcoin, and an ongoing shift in regulation from shoot first, ask questions later to actual rule books and custody clarity. Remember, volatility is the price of admission for owning the best monetary asset ever invented. If you enjoyed the show, please subscribe, leave a review, share it with a friend who's trying to make sense out of Bitcoin, AI, or the craziness of modern markets. You can find the full show notes and links, including my featured Substack post, When AI Eats Wall Street, and links to the Bitcoin Fortress books down there in the description. And until next week, stay humble, stack sats, and keep building your financial fortress one block at a time. Bye bye.